Picture this. It's a quiet weeknight, you're scrolling through your super app, and there's a small charge coming out every month that you can't quite explain. It never shows up on your payslip. And if you've never noticed it, that's not a failure on your part. Most people are never told it's even there. It's insurance, taken straight from your super account. Today, I'm going to walk you through exactly how to find it, check whether you actually need it, and switch off the bits you don't. By the end, you'll be able to do this yourself in about 20 minutes. Let me show you where to look first. Let me show you the scale of what you're dealing with. Australians pay around $6.8 billion a year for insurance through their super funds, according to research from Super Consumers Australia, reported by the ABC in 2025. The same research found about 1 in 4 Australians don't even know what cover they have, and many don't realise they're paying for any at all. So if you're not sure what's in your account right now, you're genuinely in the majority. And that's exactly the gap we're going to close for you today. Here's why this matters for your retirement. Super Consumers Australia estimates that young Australians alone are paying about $1.9 billion in excess premiums inside super every single year. That's money being drained from balances for cover people don't need, can't use, or already have somewhere else. AMP calls this insurance erosion, where premiums quietly shrink your savings more than they need to. And here's the good news that most people never hear. This is completely fixable, and it's your money to control. Let me show you what that erosion actually costs you over time. Think about what those small premiums become over time, because this is where it gets genuinely eye-opening. AMP suggests your total insurance premiums inside super should generally stay under 1% of your salary. Let's run it 3 ways. If you're on the lower end, say you're overspending by $400 a year, that could grow to roughly $37,000 by retirement. In the middle, an $800 overspend on an $80,000 salary, invested for 30 years at 7%, could become around $75,000. And if you're carrying more duplicated cover, say $1,200 a year, you're looking at well over $100,000. Small leak, big puddle. Step 1. You're going to audit every super account you own, including those old employer funds from jobs you left years ago. Log into each one through the fund's online member portal. Find the section called Insurance or Cover and write down 3 things for each account. The type of cover, which is usually life, total and permanent disability, and sometimes income protection. The sum insured and the premium being deducted from your balance. MoneySmart, run by ASIC, walks through exactly where to find this. If you're a bit shocked when you see the premium for the first time, that's completely normal, and it's the moment this all starts to click. Step 2. Now you do the maths, add up the total premiums across all your funds, then compare that to your salary. Industry guidance cited by AMP suggests your premium should generally not exceed about 1% of your annual income. So if you earn $90,000, that's around $900 a year as a ceiling. If you're paying more than 1%, don't panic, but do flag it. It usually means you've got duplicated cover sitting across multiple funds. And that duplication is the single most common problem we're about to fix. It's coming up next. Step 3. Choose one fund to be your main home for both your savings and your insurance. Now here's the honest part I want to be upfront about. This isn't quite a one-click job, and you need to pick the right fund before you cancel anything. The key thing people miss: you generally can't practically claim overlapping benefits from several funds for the same event. So if you've got life and TPD cover in 2 funds, you're paying twice for protection. You can only really use once. Pick the fund whose cover best suits your situation, then we'll switch off the duplicates. This is exactly the erosion the 2019 reforms were designed to target. Step 4. This is the action that actually saves you money. In the funds that aren't your main fund, cancel the insurance you don't need. Most funds let you do this through the online portal, by phone, or with a downloadable cancel insurance form, as MoneySmart and AMP describe. Be deliberate here. Only cancel what you genuinely don't need. Get the cancellation confirmed in writing, then check your next statement to make sure the premiums have actually stopped coming out. That's your proof it worked. But before you cancel a single thing, there's one trap you need to know about. I'll show you next. Step 5, and this one protects you from a costly accident. Under the Protecting Your Super reforms, insurance is cancelled automatically on any super account that's received no contributions or rollovers for at least 16 months, according to MoneySmart and APORA. So if there's a fund where you actually want to keep the cover, you need to keep that account active. Either make a small contribution or formally tell the fund you wish to maintain your insurance. Then check back after a month to confirm the cover is still in place. This is how you keep what you genuinely need while cutting what you don't. Now I have to flag the flip side with you because this is where the real risk lives. The same reforms that cut waste have also left some people accidentally uninsured. ASFA estimates that about 5,000 Australians a year now die without any life cover through super since the reforms, meaning their families miss out on roughly $670 million in death benefits every year. ASFA also found around 11,000 people a year miss out on about $1.5 billion in TPD benefits. So this was never about cancelling everything. It's about keeping the cover you genuinely need active and cutting only the waste. Let me knock out the biggest myth for you. A lot of people tell themselves the insurance in their super is basically free, so there's no harm leaving it. It isn't free. The premiums come directly out of your super balance, which means less money invested and compounding for your retirement. That's exactly why Australians collectively pay $6.8 billion a year for this cover, and why young Australians are wearing $1.9 billion of it as pure excess, according to Super Consumers Australia. Free it is not. Silent, absolutely. And here's the mistake that catches older members especially. Second common mistake, and this one really matters if you're closer to retirement. Insurance inside super usually has an age cap. According to MoneySmart, TPD cover typically ends around age 65 and life cover typically ends around age 70, though it varies by fund. So if you're in your 60s, you might be paying premiums for cover that's about to expire or no longer matches your life at all. Always check the age caps in your product disclosure statement before deciding what to keep. There's no sense paying for protection that disappears next year. Let's run through your playbook fast. 1. Audit the insurance in every super account, including the old ones you'd forgotten. 2. Add up your premiums and compare them to 1% of your salary. 3. Pick one main fund to hold your cover. 4. Cancel duplicated or unnecessary cover in the other funds and confirm it in writing. 5. Keep any essential cover active by making a small contribution so it isn't cancelled after 16 months of inactivity. 20 minutes of work, potentially 6 figures back in your pocket by retirement. If you've made it this far, you now know something most Australians paying these premiums have no idea about. So here's your one action today. Log into your super and find the insurance section. It takes 2 minutes and you might be genuinely surprised what's in there. If you want to go deeper, next we're breaking down how to consolidate multiple super accounts the right way, without losing the cover you actually need. That's exactly where this leads. Remember, this is general information only, not financial advice, so check your own product disclosure statement before you cancel anything. I'm Alex. I'll see you in the next one.